Is the strong US dollar putting pressure on the other G10 currencies and economies? Well, let's look at a few currency pairs facing challenges and the key fundamentals that currency traders are going to be watching. In the aftermath of the 2024 election, brought a striking surge in the US dollar, which gained an average of 6% against major developed currencies. This rally appears driven by several factors. For one, promises of deregulation and corporate tax cuts have attracted global investment dollars to American shores. Additionally, the new administration has intensified discussions around fair trade deals, including the possibility of retaliatory tariffs. The administration's trade focus has been fluid, moving across multiple fronts. While China remains a persistent concern and the target of new tariffs, attention has now shifted between the Eurozone, Canada, and Mexico. With our North American neighbors, discussions primarily revolve around border security. The Eurozone, however, is a bit different. The administration has highlighted European tariffs on American goods, measures that date back to post-World War II reconstruction efforts. For Europe, the timing of these trade policies couldn't be more challenging, coinciding with Germany's weakening economy. This perfect storm helps explain why the euro dropped more than 9% against the dollar between October and January 13th. Even with the current weakness, though, the euro still sits well above its fall of 2022 lows, a time when the Fed was hiking aggressively to combat inflation. Now, a new variable has entered the picture. Inflation has resurfaced in the U.S., rising above 3% in the February 12th CPI reading. Looking ahead, euro currency traders are focusing on two critical developments: the timeline for implementing these trade policies and significant inflation movements on both sides of the Atlantic. The reason? Well, accelerating inflation could push either central bank to raise rates, potentially strengthening their respective currencies. Now, CME Group offers three different size currency contracts: the standard, the mini, and the micro, in order to match a trader up with their preferred risk tolerance. We are going to be using the micros in these examples. If a trader believes that Europe's currency could fall from here, they could express that by selling the micro euro futures contract at 1.0470 and target a move to the early February lows of 1.0250. A stop for this trade can be placed above at 1.0540. Now, this trade can make $275 if the target is reached and risks $87.50 if you're stopped out of your level. Now, if a trader believes the euro could go higher from here, they could buy the March micro euro futures contract at 1.0470 and target a move to the November-December congestion area of 1.0600. A stop for this trade can be placed below at 1.0390. Now, this trade can make $162.50 if the target is reached and risks $100 if you're stopped out of your level.